Alright, ladies and gentlemen, hello and welcome to yet another video of Danny in Research. That's me, and today we're gonna look at what happened last week, what is to happen this week, and stick around till the very end because I have something special for you, a bonus round of information based on real research. Okay, so do not forget to like and subscribe to the video and this channel. You really help me out and I'll be very grateful. Alright, so this week we've had a lot of stuff happening, a lot of economic data, earnings. And yet again, if you look at the Nasdaq chart, we didn't really do that much. Well, yeah, sure, we were up, but I mean, look, this is a weekly chart right here. So the range is 2.3%, but we closed just 0.16% higher than the previous week on the Nasdaq. So really, I could say that that's kind of an indecision candle for this week, and let us explore why this is an indecision candle. What is the reasoning behind it? Okay, let us start as always chronologically. Monday, not a lot of data. It was just a few Fed speakers. It was a bank holiday. The bond market was closed, and it is my view that whenever the bond market's closed, it's really not worth it to go in and place trades. Because, as I previously mentioned, for me the bond market is the smartest market, the biggest money. So whenever they're on a vacation, whenever they're chilling on their yachts, you should probably do the same. Or at least prepare for the next days by doing research, by doing an analysis and preparing your place for the next days. Alright, we have Tuesday. We've had the Empire State Manufacturing Index, which plummeted. Okay, it plummeted. Let me just show you really quickly right here, this picture. This shows the Empire State Manufacturing Index. As you can see, it has plummeted significantly. It's in a downtrend. So we haven't been at these levels since before the pandemic. Well, actually, after it as well, but since you can say that it was a recovery, V-shaped recovery right here, so essentially it is right at the level where we were before the COVID crisis. Okay, so other than that, we had some Canadian news, not such big catalyst there. It missed on inflation, so better than expected inflation. And then we had Wednesday. Wednesday, again, the biggest thing here, Britain's CPI miss. So better inflation in the UK, which led to the pound rallying finally after having some trouble staying up against the dollar. Alright, so then what we had, we also actually had the ASML earnings, which were supposed to come out later, but someone or something had a bug, a technical issue as they called it, and they were released earlier. And essentially what happened was that the stock dumped over 17%. Right here is where the earnings were released. So we were trading quietly in the markets, in the US markets, etc. But then again, at 5 o'clock my time, it was like floating, and then bam, from out of nothing, the ASML earnings were released, and they were worse than expected. The key thing here being that they are expecting quite a significant miss on their orders from the European Union in the following quarter, the following year as well. So I do have a contact at the ASML, and he told me that they pretty much knew that the quarter is not going to be great before that. And you can see that this has been reflected in the chart, right? If you compare that to Nvidia or TSM, they have been down quite significantly from their highs. Before the earnings, it was like down 22%. So, but then again, it was still a surprise to the market. And they even had a emergency meeting at their company the new CEO made an emergency meeting and he explained what is going on. And essentially, this is it. We had the bad earnings, and in total went down about 22%, and it has rebounded a bit since. And this is partially because we had the TSM earnings a few days later, and they were actually pretty good. Okay, so they did beat on earnings, and after they beat, they were up like 13-14% at one point. Now up probably around 6% since the earnings, right? So essentially, what we had here is ASML earnings first, a disappointment. So this was a bad catalyst. But then we have TSM earnings, which was a good catalyst. And what happened in price? Oops. Nothing happened. Oh, right here, nothing happened. Okay, so very, very interesting. If I were to show you, I don't know if I'm gonna be able to show it very nicely now, even though I had the picture. Yeah, I'm not gonna be able to show you to here, I guess. But no, it's right here. This candle. Look at this candle. So on Wednesday we closed here. Then on Thursday we opened up higher, but then we closed at the zero level. We closed at the zero level, and even the futures, guys, they were 0%, so unchanged. Total indecision. After sweeping the highs, we went down and closed below it. But why was that indecision happening? So it's not just the chips earnings. It is also Thursday's big catalyst, which is the main point of this video now. Retail sales and unemployment claims. So retail sales beat big. Okay, they beat big. We were expecting 0.1% change month over month, but then we got 0.5%. So this is very big. And you could say, wow, there's no recession. Recession's cancelled, right? Right. But then again, let us look into this. The biggest September seasonal adjustment on record. On record, okay? So this is the biggest adjustment in this metric. So essentially, the real number is very bad. If you look at the unadjusted number, it is actually very bad. And I think I do have a picture of this, but I'm just trying to see if I have downloaded it. And even if I don't, it's fine, I guess. Yeah, okay, I haven't downloaded it, but anyways, so if you look at the unadjusted number, it's actually very bad, right? And if you ask yourself, okay, but how are they adjusting this? Nobody knows, okay? It's a mystery. They adjust it however they see fit. So if they say, okay, we think we should adjust it based on this, this, and this, sure, okay. And then the headline number, better than expected. Everything is great. However, the market said, you know what? We don't know what to do with this. You see, we open up higher, but then we went lower and closed at the zero level. So not only did the chips report mixed earnings, but then we also had the data, which was very, very inconclusive since it was revised. Like an initial reaction, up. But then when you look at the unadjusted numbers, you see that it's not all roses. Right. Unemployment claims, right on the money. We also got the Euro Bank. They had their press conference. I watched it, but let me just quickly go over the short view of the decision right here. Right, the Governing Council decided to lower the 3 key interest rates by 25 basis points. Right? All right. But what they say here, inflation is expected to rise in the coming months before declining to target in the course of next year. So they're expecting inflation to go up now. Domestic inflation remains high as wages are still rising at an elevated pace. And this is key now. At the same time, labor cost pressures are set to continue easing gradually, with profits partially buffering their impact on inflation. So they're expecting profits to go down. All right. I think there was something very interesting here, but if I don't find it, that's fine. Not here, not here. Right. Here, the incoming information on inflation shows that the disinflationary process will track. Yeah, that's true. We know that. Since there's a slowdown in the European Union, we can expect inflation to go down. The inflation outlook is also affected by recent downside surprises in indicators of economic activity. Okay, so they are acknowledging here that the European Union not doing that great. All right. Okay, now then we had Friday. Pretty light, right on expectation, building permits. But now, let me show you what you've been waiting for till the end of this video. Y'all ready? Y'all ready? Watch this.
Technicals are fiercely strong.
The amount of liquidity in the markets is phenomenal.
I still think you're going to get the best juice from the equity market.
You're seeing it, stocks and bonds are trading uncorrelated.
It probably is far more uncertain for bond investors than it is for equity investors.
This is Bloomberg Surveillance with.
So what do you notice? Did you notice a trend? Did you notice a certain bias? Because I did. Everybody's positive. Everybody is saying, yes, bull market, it's good. The economy is great. This market is unstoppable. Right. So the bonus point here. Why are the media not showing this side of the economy? Why are they showing just the good stuff? And why it is so important to watch videos like mine, where I try to give you an unbiased opinion based on the data, based on what I am seeing, and not based on what the agenda is. Right? Even though sometimes I can lean one way, as I told you, for example, this week, even though the data is revised, it is still kind of bullish for the markets in the short term. Right? So let us see why. Okay. Alrighty. Here we go. Okay. So what we are looking here is an article from the Journal of Finance. It was published recently in October, so this is a very fresh publication. It's called Business News and Business Cycles. What those guys did was essentially get a huge sample of Wall Street Journal articles from 1984 to 2017. They estimate a topic model that summarizes business news into interpretable topic themes and quantifies the proportion of news attention allocated to each theme over time. Let us just quickly look over this. Okay, so what they're saying is, remarkably, they find that news attention explains 25% of the variation in aggregate stock market fluctuations. So the news can explain about 25% of the stock market movement. Our second contribution is to show that news text contains distinct incremental information compared to standard numerical indicators. We consider two important applications of our topic model: macroeconomic factor, autoregression, VAR, and stock market timing. First, we study news attention with an otherwise standard macroeconomic VAR. We find that news attention to the recession topic has economically large and highly significant predictive power for future output and employment, after controlling for a variety of common VAR components such as stock price, interest rate, and measures of economic uncertainty. That is, news coverage of recession risk captures useful information about future economic outcomes above and beyond commonly used indicators. Okay, so as I previously told you, I think that the media is not going to cover anything related to recession. First, because the big institutions want to have enough buyers to be able to unload their shares to the retailers. And second, and more important, that by covering a recession and recession fears, what is going to happen is that it's going to be like a domino. So when the media starts saying, oh, recession's coming, guess what? Recession is going to come because everybody starts selling, stock market goes down, and recession comes. Layoffs, unemployment spikes. So, and here, this is a proof. This is proof, a scholarly proof from one of the best journals in finance. So those guys did a huge study, and they even have a website that I'm going to show you just briefly, and I'm going to be posting it in the description so you can check it out and see what I'm saying here and test it yourself for whatever data you want on their website, which is based on real data and not just some analysts blabbing around on CNBC, sorry. Okay. For example, we find that large shifts in output growth expectations are associated with news articles headlines such as consumer confidence slides of fears on layoffs. So exactly what I said, right? So the growth expectations are associated with articles that are saying that growth is gonna slide and consumers are bad, right? And stocks fell further amid concerns prices don't fully reflect worsening global growth. Using the topic model as a narrative retrieval device, the researcher can map changes in model forecasts to nuances textual interpretations of economic events, for example, news articles. So in essence, the estimated model flags articles that the researchers should read thoroughly without requiring close manual read on every article in the Wall Street Journal. Topic models have only recently begun to be explored in empirical economic research. Papers by Larsen and Thorstrud and apply LEA to Norwegian news data and analyze macroeconomic forecasting models. Complementary research integrates news text into macrofinance analysis using carefully curated research inputs in place of statistical models. Right, so those are a few of the other studies that are concentrated on this, but this is a very new area of research. We also contributed. Yeah. So what? And there we have some of the more technical data. The data set they use is the most extensive text of business news study in the economic literature to date. So this is the biggest sample size of such data to date. It consists of all articles published in the Wall Street Journal from January 1984 through June 2017. This represents the longest history of full text articles in digital text format available. Okay, there's more data. I'm going to be linking that into the description as well as the website I'm going to show you just briefly now. Okay, so yeah, these things you can see yourself, but let's just see lastly this thing here. Macroeconomic aggregates. So among the 5 selected topics, news attention to the recession and all market topics significantly negatively correlate with output growth. The coefficient estimates are economically large. A 1 standard deviation increase in recession attention associates with a 0.38 standard deviation drop in output growth. So they have proved, they have made a causation proof that a attention increase in the news in regards to a recession actually leads to a drop in output growth. In fact, recession attention is by far the strongest explanatory variable for all 4 economic aggregates. Right? It directly leads to a deviation drop in unemployment, non-farm payrolls growth. Guys, this is big. Okay, this is why you need to pay attention to videos like this, to people like me who are not biased by the media, we don't have that much of an influence to be able to cause the recession by us talking about it. Okay, and the thing is, when I know that I'm not gonna cause it myself, I am able to speak more freely and change my bias faster in order for me to reflect on what is happening currently. Okay, right. So this video actually is pretty long now, so I'm just gonna link the site that I was talking to you about, where you can see it just looks like this, right? You can see yeah, you can take a look at it yourself. It's gonna be in the description. It's based on the data, it's based on the research. As always, everything here is. So thank you guys so much for watching. I'm gonna make another video this week because there's so much to talk about. I even haven't scratched the surface on the dollar, on commodities, on the yields. But I just wanted to show you this research now and why you're not going to hear this in the media. You can watch the media, you can inform yourself about stuff from the news, but do not base your opinion solely based on the mainstream media. So thank you guys for watching this video, and see you guys in the next one. Cheers.